ladies and gentlemen, news and technical traders from all around the world. Welcome to OANDA's Trade the Markets in March with Alfonso Esparza and yours truly, Ed Moya. If you could kindly just let us know if you can hear us in the chat, that would be great. This month, we're going to preview all the major events. We're going to go over some charts in this 1-hour webinar special. For those of you who are regulars, our colleague Craig Earlham is on holiday. He is resting up for the Brexit fireworks that will possibly take place next week and on the Brexit date. And so he should be back next week. And Alfonso, good morning. How are you?
Hello, Ed, and hello, everybody. Glad to be here. And as Ed said, filling in for Craig Earlham. So ready to chat with you guys about the markets. Lots of things to talk about. We'll be discussing what's the upcoming 2 weeks. It's very important what's happening in what we have in the pipeline. And also looking forward to your questions, and please use the question form freely. We'll be monitoring during the webinar. So anything that you can think of or any comments or questions, please let us know and we'll address it as we go along. Right now, I think we're just giving a little more time for people to join. I think just past the 5-minute mark, and we'll probably start.
Beautiful, and I think that this is going to be a very macro-intensive month, Alfonso. I know that in our regular MarketPulse meetings, we're always covering all the big topics, but it seems that this month especially, it's going to be heavily focused on the trade wars, the many key central bank rate decisions, and we're always, tracking that U.S. economy, and it appears that, as most of these central banks are becoming data dependent, we're always trying to find, are we, is the economy cooling? And if so, when are we going to start to see some of these key inflection points in the markets? And we'll definitely dive further into all the details, into the nitty gritty, and once we go into the charts.
Yeah, so just giving you guys sort of a run through of sort of our game plan for today. We'll be discussing, like we're doing right now, so just the bigger trends, what's happening with Brexit, sort of what the events we've seen, central banks, a bit of a look ahead, and risk events that could impact the markets. And moving on to just the detailed view of the calendar. And so we'll also be discussing what's upcoming, the potential implications or actions from central banks or that economic indicators. And then we'll just dive straight into the charts, and that'll also give more opportunity for you guys to just start shooting questions our way as we move through the charts. And just sort of a heads up for markets, we are very aware of our audience, so we want to sort of give you guys what you want to take a look at. We'll probably start very sort of pound-centric, euro-pound, cable, moving more into Europe, touching upon stock markets, focusing on the US, the yen as a sort of a catalyst, safe haven, canary in the coal mine, and finish off with a bit of a look into commodities with a quick look at gold and Brent. So anything that you like to see, just let us know. And if time permits, we'll add it into the list. Just a reminder to use the tools that OANDA makes available. We have a lot of very different tool sets and toolkits available for all types of traders, be it technical traders or it's also fundamental. So we always like to know what's happening with even our own client base so that you can see the open orders, open positions. But we also deep dive into what's the CFTC numbers or the commitment of traders, things like that. So please take a look if you haven't, fxtrade.oanda.co.uk, analysis/labs, and you'll find all the tools there. And of course, MarketPulse. So this is a very global, diverse team that is here for you to provide commentary on what's happening in the currency, stocks, and commodities markets. So we have our main hub website where we publish all of our content. So you'll see stuff from Ed, Dean, who you know, Craig, obviously, and also our 2 analysts in Australia. And let's just take a look ahead at the calendar. So as you see, next week, or actually this week, is going to be very interesting in terms of what central banks we have. The RBA already basically held, and I think that is going to be the theme of the week for central banks, is wait and see mode. So we've seen the Bank of Canada, how they've sort of shifted the lines a little bit after the start of the year. I think all central banks sort of finished on a strong note and had to pull back in January. So we probably will see a continuation of that here for the Bank of Canada. So no rate change for sure, but we're also very looking into what does Governor Paulus have to say. So after a very hawkish end of the year and start of the year, which was rare for central bankers, I think this is the time where things might be a little bit neutral, or he gets a little bit more patient as joining sort of the crowd. ECB will expect some of the same. Actually, the job for the ECB is probably harder at this point, just because of how things are panning out in European economy. So we've seen that loss of traction. We've seen that it's sort of the inflation is still struggling, and when rate hikes were a possibility this year, I think now they're getting further ahead. And it's probably this meeting that we'll see some hints, or just straight up addressing that fact from the European Central Bank. Ed, anything on this week?
I think you're right when you're talking about it's more of a patient approach with all these central banks. And while no change is expected from the ECB, one thing that I am excited about is that they are going to go over their forecasts, and a lot of times you'll get to see is exactly well, how bad are things, and also too, they might discuss new longer term loans. So we're gonna see the theme, I think, over the next few months for a lot of these banks is wait and see, yes, or are we going to have to do a little bit more to help push the economy back in the right direction?
I think you're touching a good point. I think when we were talking about rate hikes last year, this year is probably the ghost of the rate cut sort of started to loom. So we've seen that in some cases, the market is pricing in the probability that a rate cut could happen in the U.S., and that's something that was probably unthinkable last year.
No, yeah, very, very much so. And then as we wrap up this week, and we're just trying to tackle the in theory what could be the most market moving events. We have non-farm payrolls, which when you look at the U.S. economy, it's kind of like there's two stories. There's the strength of the labor market, and then there's the rest of the part that's a little bit softer, the sentiment and some of the key data points. But the employment situation is strong. We're still expecting to see strong job growths, and when we go into the charts, we'll dive in deeper. But those are going to be the key ones for this week.
And I think this week saves the best for last, and I think it's going to be something that, as you said, we're used to really great employment numbers, very solid. It's been sort of the strongest pillar in the recovery, but it's also not as impactful as it was in the past just because of that. I mean, we expect something great. It's the net change in employment is probably going to be the biggest in terms of the wages, hourly wages. So that is one that the market is now laser focused in. So where's the inflation? Is it coming? What's happening there? And it's the one that, as we've seen, the U.S. economy is starting to gather a bit of momentum. It's been mixed this year, but if you look at overall, like if you take sort of the other major economies that are struggling at the moment, the U.S. economy looks really good, and that's one of the reasons that it's very hard to discount the dollar, despite what's happening, or even the president's tweets and desires that the dollar goes lower. Right now, we're seeing that it's a very strong economy in comparison. And I think on the central bank front, we'll see the Bank of Japan, and it's sort of an interesting situation. We've seen sort of how much and how hard they've gone at sort of their growth issue. They've thrown everything at it. We've seen like massive QE, bond buying, you name it, stock buying. They've tried it all. They're really throwing the monetary policy handbook at this thing. and unfortunately, it hasn't really given them a lot of positive results. So, what do you see for the Bank of Japan going forward, Ed?
Well, I think the data warrants the downgrade of their assessments of lots of key parts of the economy, and a dovish shift. I think that's that's the theme for many of these central banks, and I think we're going to see that also possibly take place with the BOJ.
And just as a reminder, this week is, every week is massive for Brexit, but this week in particular, so the week from Monday, March 11th to Friday, March 15th. And we're also covering that. So Craig Erlen will be covering, live tweeting Brexit news. So please look out for that. We'll probably send a reminder to your emails, but it's something that we're trying out. So if you are into Twitter and want to see what Craig thinks about it and displays it on Twitter, please follow that. And as promised, here's the cable. So Ed, can you get us started?
Yes, definitely. So when we take a look at the British pound, you can see that for the most of the year, we have seen a steady rally. Finally seeing some higher lows and higher highs. The last few days not reflective of that. And the main reason why the British pound did start to stabilize is because that the fear of a no-deal Brexit was pretty much alleviated. Expectations were pretty strong that we're going to see. Right now, the base case scenario is for Article 50 to be extended. Is there a chance that we will see Prime Minister May's deal get voted on? Right now, the Attorney General is going to Brussels right now, trying to get some tweaks for that backstop. Will they get something? My gut says it's going to be hard for the EU to concede that at this point in negotiations. So most likely we're going to see them have to vote on May's deal. Maybe there will be some small adjustments, and it's hard to get a sense of what will happen there. But the fear of that no deal Brexit has been off the table, and that's why we've seen the British pound here pretty much rally steadily since that Christmas Eve low of 124, around the 124.20 region. And now technically, what is interesting, the price action has taken a significant move above all three key simple moving averages: the 50, the 100, the 200 day. So as we see cables start to pull back here over the past few days, we are going to see that 130 level be key support. If we do see that level breached, 128.50 will be the next key support level. And to the upside, 135 is going to be a key target for me, and I think that we're going to definitely see the volatility pick up. So leading up to the big week, we will see some investors will start to try to place in their positions, but as you can clearly see on the charts right now, the fears of the no deal Brexit have been for the most part priced out. So we're gonna start to see possibly some normal trading here.
Yep, and I totally agree. And I mean, you can see the optimism, sort of the no deal hope reflected in the chart. We've seen sort of that lift that has gone, and I think right now everybody's at the table ready to start work, and I think they left it a bit late, but I think that they're using that deadline as leverage. I agree that an extension in time is probably the best option at the moment. No one wants a no deal, even or at least the markets don't think that's a great idea, and it would probably punish the pound either way if that comes about. So whenever there's that phantom that a no deal Brexit could happen, then you'll see it reflected in the pound for sure. And so what we're seeing now, it's just there's hope, this lack of details as well, so that's why it can tend to be volatile. So basically the two scenarios right now is there's an extension, which is probably likely. Everyone just needs more time. Arbitrary dates were set back when the Brexit referendum and Article 50 was triggered. So now maybe a little bit more room and a sense of urgency will probably act as the leverage needed to get a deal on the table and agreed by all major parts. If not totally, at least a deal that everyone can live with.
And as Alfonso switches to euro sterling, you'll see that the euro has been heavily battered. When we look at all the advanced economies, it appears that Europe is the weakest, and you can see that for most of the year we've seen euro pound really it was hanging on to the 0.90 level, and it's been a precipitous fall here. It is trying to find some support around the 8,500 region, and right now I think we're going to see this possibly trade a little bit more initially on European news.
Yeah, and also to bear into this is the weakness of the European Union. So we've seen sort of in a head-to-head, it's probably the Brexit headlines are probably either putting more pressure or helping the pound a bit more than the euro, and the euro is just sort of reacting to domestic issues. For the moment, political headwinds within the union seem to have died down. We haven't heard as much as sort of out of Italy, which doesn't mean it won't happen again, but for now it's out of the headlines, so it's not really impacting on the currency. But what we've seen is a bit of a slowdown in Germany. We've seen manufacturing not going as well as it should, and as we all know, Germany is the engine of growth in the union. So when Germany's not going well, that's definitely not going to be good for the European Union as a whole. So I think the sort of the main driver, or at least what has seemed to be sort of one of the biggest factors, has been the U.S.-China trade deal. And we've gone back and forth. We've gone from ceasefires after the G20 in Argentina to all-out open war or tariff war, trade war. So this is words that were like used and thrown around last year pretty evenly. I mean, Trump got into it in tweets. And so what do you see, or what has been the most recent impact of the U.S.-China negotiations?
And right now it is all about China, and the optimism is at the highest levels we've seen throughout the negotiations. This year-long trade war is trying to wrap up. Their growing expectations we will get that mid-March, possibly later March meeting between the presidents Xi and Trump to finalize the trade deal. As we see lots of progress on the key concerns. Intellectual property theft, IP, I'm going to call it, has been one of the key barriers. And as the agreement, and it's over 100 pages, 30 pages are dedicated to IP. So there's definitely progress on a lot of the core issues. The problem is that, how are they going to enforce it? There's also an implementation question. So there's even though if we do get that deal, it might not necessarily be what what is needed to kind of provide that next catalyst for risk on, for stronger equities, for high beta currencies to rally, for the dollar to possibly see a little bit of a pullback, because the uncertainty as far as, is the deal going to take place immediately? Is it going to have to be scaled into? And then also too, the punitive measures that the U.S. wants to have in this trade deal. So let's say if China does not comply, well, the U.S. then wants to be able to say, okay, well, here comes a round of tariffs, and so there has to be an agreement there. Now that is something that is still being discussed, and depending on what they finalize, the markets will be very skeptical as far as they want to see clarity. They want to see all the 200 billion tariffs removed for China that are being imposed by the U.S. and they want to see China open up their markets more to the U.S. And have these measures be firmly clear. So there's still a lot of uncertainty. We're at mile 25 in this marathon, and the last mile plus is going to be the hardest part. But both sides are highly motivated, and I do believe that the president is going to want to wrap this one up, as he's going to need to focus on other trade wars that he's starting to mention.
Yes, that's a good point. And I mean, if we see sort of the decline in December in stocks, it was the 1-2 punch. So we have a trade war in one hand, that we have like various companies just basically saying, oh, it's affecting our direct bottom line. We have, I think it was Deere or like Cargill, like the tractor manufacturers in November, December, starting to like feel the pain of sort of those China tariffs. And I think the catalyst was Apple in January, just sort of like saying that, yeah, there's issues there, and that the trade war is not helping. And the second one was the Fed. The Fed, everyone just maybe a patient, slow down approach, gradual, as they say, but they were on track to hike for sure 2 times in 2019. So all that basically took a toll in the markets in December. We saw sort of the sell-off, and now some of those situations have resolved themselves. U.S.-China, we're close to an agreement. As Ed mentioned, there are still a lot of details that we don't know, and that really could reverse the position of the market. And is this really a good deal? But the other part of the equation as well, the Fed has retreated. The Fed is now patient, wait and see. There's really no rush, and you see it in every Fed member comments, voter or non-voter, hawk or doves. They're all doves now at the moment. Everyone's sort of taking a very patient approach. So what we'll see is that, yeah, if and that's a big if, the economic indicators really show a stronger than expected U.S. growth, then probably we'll see the Fed start to introduce a bit of a more hawkish tone and prepare the market for a rate hike second half of the year. But for now, we've seen them; they're out of the market. They're just sort of keeping expectations on their wait and see for the moment. And what can you tell us about the strong dollar, Ed?
Well, I think it's safe to say we've seen some range trading here, and as the Fed has delivered that, as you mentioned in January, that dovish pivot, rates are going nowhere. Typically, and when you come from you take a look at what was happening last year, it was all tightening, rate expectations were, some were calling for 4 hikes in 2019, and you have a major policy change as far as where the Fed is going, and you see not much of a reaction, and that's because Europe is very weak. Europe has seen terrible data. There is concerns too that the Trump war will then switch across the transatlantic and go into Europe, and there's also concerns as far as we have lots of political uncertainty. We have some countries doing a lot worse, as you mentioned, Italy before, and right now when we take a look at the charts, there's just been a consistent consolidation. I think that right now when we take a look at the Euro chart right now, a lot of it has been dependent on the weaker data that we've seen from Europe, and for prices to break out, I think we will need to see that overall next step in as far as where is the Fed going to see their next move, because right now there's really no strong inclination, and I think that we're going to possibly see a little bit more consolidation before we do get to the eventual breakout here. But as it coils up, right now there is lots of lots of support seen at that 112 region, and then to the upside, 115 is key resistance. So you could see some good range trading, but eventually, you will see the markets take a position. And I think one of the things that I've been tracking is the spread between the tens and the twos, and we could see as the Fed had their policy shift, that the fear is that when the 10-year and the 2-year treasuries, when they invert, it triggers the recession. And right now, that spread is widening. So the Fed's message has been clearly put in place. So we are not seeing any strong moves as far as that narrowing, and until we do, right now, that could be very supportive for the euro dollar if we do continue to see Europe stabilize. Italy's GDP, like this morning, I think the final reading came in slightly better, and there were some good beats in the services PMI. So a lot of data dependencies that we're going to be tracking to see if Europe does stabilize, and right now the range has been the key for me on euro dollar.
Agreed. Like a big catalyst would be needed to go and towards that 115 level. Maybe even getting a bit back to Brexit. Maybe Brexit is that event if it's sort of there's a good agreement that keeps some of the benefits of having that cooperation between the two bodies. So if that can be found, maybe that's the catalyst that takes the euro higher. One of the reasons also for the rise of the dollar in particular was it's a safe haven. So when the U.S. went after China and sort of triggered a trade war, we've seen the sort of the appeal of the dollar as a safe haven. No one wanted risk. No one wanted to have to be short dollars going into weekends. So we've seen that start to die down, that both sides appear to be close to a deal. So there's some loss of momentum for the dollar going forward as that gets resolved. So there'll be less safe haven flows going into the dollar. So that's also going to be interesting going forward. So what happens with U.S. politics as well? So that could sort of trigger both sort of a flight to safety. Could or not include the dollar, depending on how things break out. But for the most part, people tend to go for the buck as a safe haven in terms of extreme volatility. With that, let's actually.
And we do have a question. A client is asking, how long of an extension will Prime Minister May look for?
That's a really good question, and it's one of those things that I think right now just getting the extension was probably going to be the biggest victory for May, and just it might be the thing that can unlock Parliament. I think if she can manage just getting that and getting sort of the Conservatives in some sort of unity behind her, then we could probably see the agreement. I think the extension is the time limits is not as important. I think we've seen the EU start to loosen a bit up in terms of regards to the backstop. I think we're now talking about a semi, like a not a permanent one, so that's even if things go terribly wrong, I think that everybody's sort of trying to avoid the no deal, and I think it's more the getting the extension is more important than actually what even the details or the length of that extension, if it allows either both sides to sort of rally behind a solution and then back it and then probably agree to it.
No, well said. And if you put a gun to my head and you said, well, what would be a key date to watch? I do think that the elections that are coming up for the European Parliament, I think that starts May 23rd, and then I think they'll take their seats early June or July. Well, I think they would want to try to have something finalized before having to go through those elections. So that might be a key window to watch. But as Alfonso said, there's no set clear expectation on when that would be, but yeah, we'll definitely know, and definitely follow us on Twitter next week when we'll be covering all the fireworks.
Yeah, no, for sure. And so right now, moving on to the yen, and so as we mentioned before, sort of safe havens, and we've seen how the sort of yen has either reacted positively or negatively, as well as risk on, risk off affects the market. And I think you mentioned, Ed, that we'll see what the Bank of Japan is thinking about it. We're starting to see a bit more dovish. They've been, as I said, the handbook has been thrown at this from the Bank of Japan. They probably have tried everything twice and probably as much more funds than any other central bank in the world, and they don't seem to be making much headway.
Exactly, and I think you hinted towards something. And when you look at dollar yen right now, if you look at that chart, it is very similar to the S&P 500. You've seen lots of strong correlations. Or also too, when you mentioned, we were talking about euro dollar. You were spot on when you mentioned, you could see that move with Brexit. The correlation was very high over the past few months as far as, the euro's moves when, we did have positive Brexit news and vice versa. So when we take a look at dollar yen, safe haven trade is what I clearly see. You could see that the rebound coincides exactly with the sell-off that we saw when you highlighted the Apple profit warning, the all those major risk events, that is clearly reflected here. And as we start to see, and one interesting point too is, when we take a look at this this sell-off, which I mentioned is extremely correlated with the S&P 500, we've seen 20% declines in a 4-month period in a non-recessionary environment happen a handful of times, and each time we saw a retest of that key low. A lot of economists, a lot of analysts were expecting, to see that pullback take place. It didn't, and you can see here, risk has been fairly steady. Right now, we've been a little bit consolidating here over the past few days, as we're awaiting the further details on the trade war, as far as the also to I do believe that you will see some type of a general risk on, risk off move with the Brexit negotiations and decisions. So right now we're really seeing this be a very clean safe haven trade type setup here. So as we get better U.S. economic data, this has been supportive for dollar yen, and you at the end of the week we could see that employment report do provide, if there is a better reaction, it could be more towards on the dollar yen. Expectations are high. I think last month's number really kind of caught me off guard. The 304 jobs created in the 304,000 created in the month of January, and there's going to be a very close watch as far as, do we see that number revised downward, and are we going to continue to see jobs at that kind of around that trend figure, I think 185,000 or so. So lots of good moves here with dollar yen, and we'll see that one be heavily focused on, risk off moves.
Yep, no, yeah, all good points. And yeah, I agree with you. Like the monster jobs report has always sort of now it's a bit of a trend that we have a monster jobs report, but last month gets revised downward by pretty much almost the same amount that the gain was. So we were kind of just pushing forward that extra gain that impresses everybody, but then it's still showing a very solid employment in the States, but it's a bit questionable how sustainable is it, how real is it, and that's where we go into wages and the wage growth, and we've seen that it's not growing at the same pace, and the productivity might be higher, but if it doesn't impact wages, then it probably won't be as good for the dollar. And I think you touched on sort of the R word. So are we on the brink of a recession? You hear it from both sides. You hear that we're close. You hear sort of the yield curves, the inversion, and you've also sort of start seeing like stock market returns. You see, is a recession sort of in the short to midterm happening? A global recession.
I was all excited because as far as every day I'm heavily focused on the U.S. economy, but as far as the global, let's answer the global question first. Right now we have all the large central banks pretty much maintaining an accommodative stance. The Fed is on hold, which is good enough. China in their big National People's Congress Policy Summit, unveiled uh, fiscal stimulus, the tax cuts, which they're trying to make their economy more domestically driven. It makes perfect sense. They're measures that they unleashed. We are still going to expect some more monetary stimulus too from them. ECB is, as you mentioned earlier, rate hikes. They keep fading into the future. Right now there's barely like around a 45% chance that December could be a hike. So ECB is on hold. RBA, housing is a big concern right now for both the RBA and for the Bank of Canada. Those rate decisions are likely to be on hold for some time. This past one, this one coming up for the Bank of Canada, a few months ago was priced in that this was going to be a rate hike. Now it's definitely on hold. There's just too much accommodation right now. And the other key thing that is important to track when you're talking about recessions is credit. And right now the credit markets they're not concerning just yet. I on a more regular basis will track the credit markets, and credit is still healthy. And right now if people are if businesses are having trouble getting money, getting loans, if housing does stabilize, that's good for credit, that's good for the economy, and it is tough to see an environment in the U.S. specifically right now, if we'll to have a recession if credit is so strong, and if we do see a lot of this accommodation be given by the Fed. The global economy is strong, is trying to stabilize right now. So I'm a little bit more cautious on the global economy, but right now I'm very still optimistic on the U.S. side. And I know you're going to add something. We do have a question too, as far as what is the purple trend line from a client.
So I think I agree with you in the sort of overall terms in the recession, not sort of being too likely in the short term, just because of what you mentioned. I think the lessons from the last recession, I think the financial services in particular, have been really strong. The lessons were learned. I think we've seen that they're less of risk takers. I think we've seen the banks in particular. Maybe I cannot generalize because again we've seen sort of the Italy right now, Spain. There's some issues there, but overall, and it looks healthy, and it could probably withstand and keep at the same rate. And this is why I sort of agree with you that I'm more optimistic probably of the U.S. economy, and that is one of the reasons that the dollar won't stop, and we've seen sort of that trend. Trying to just people going against it, and they haven't really come out on top. And we've seen sort of what the rest of the world is a bit slowing down, but not to the point where it's racist and like red flags all over. So I think we're in a good spot globally. It could be better, and I think yes, trade has taken a bit of two steps back with so many sort of disputes. We've seen sort of the U.S.-China trade war. There's the car tariffs now with pretty much everybody, and that will probably have a bigger impact in Europe going forward. But at the same time, we're starting to see that those concerns have been eased as much as if there's an agreement, if some people get together in a room and start hashing it out, that we'll see that not come to fruition. And regarding the charts, getting back to that, it's the stochastic, so it's the default setting. So the oil markets have been very bumpy in the past couple of years. We've seen sort of the fallout from the just rampant production from OPEC countries that created sort of a free fall for prices, and then we saw like that the OPEC itself had to regulate and sort of agree to limit their production. And the funny thing is that at the same time that they were doing that, and the reason they did that was to keep U.S. shale under control, and it kind of backfired on them price-wise. But now it's again a threat to their plan. So we've seen there's this very thin balance between U.S. ramping production and the OPEC countries and other major producers such as Russia trying to limit their production to keep prices stable, try to soak up a bit of that extra crude in the markets. And sort of the chart sort of speaks for itself. How's that working out? There's been some successes. There's been some sort of setbacks. But also you could see is the impact of the trade war, because one of the sort of the side effects of the US-China trade war was that it reduced the growth forecast around the globe. And so if the global economy is going to grow less, that means they're going to demand less energy. And that, of course, is going to be impacted directly on the price of oil. Ed, any thoughts on crude?
No, well said, and I think that we initially saw oil a little bit softer this early morning on concerns that China's response is to slowing growth, and right now one of the key things that as you mentioned, we track the commitment of traders. There's also to the ICE futures, where the data last week kind of showed that hedge funds, I think it might have been the 8th consecutive week, they raised their bullish bets. So there's a lot of optimism that with China coming to bed, and most likely it was expected for them to deliver strong stimulus, supposed to be supportive for overall global risk appetite, and with the trade war coming possibly to a positive conclusion, could be good for that demand side argument. Ultimately I think the production, and once we get to the warmer months, the U.S. production right now is showing signs of stabilizing, but the trend has been pretty strong. And if prices are at these levels, you're going to see the U.S. oil players want to take advantage of these high prices, because I think many people thought that we ultimately could see oil trade between 40 and 60 for WTI, or 50 through 70 for Brent. Some a little bit more optimistic, some a little bit more pessimistic, but ultimately there is an expectation that we could see some key ranges, and right now there's still a lot of optimism for further upside here on the a lot of these macro hedge funds. And yeah, I think that you see it be heavily focused right now. Supply disruptions, yes, that's always a key move driver for oil, but I think the trade war is going to be a major market event that will affect all asset classes.
Yep, agreed. And sort of going forward, the sort of that balance will continue, and that sort of fight between rising U.S. production and whatever the OPEC Plus decides to do. And the main challenge for the OPEC is how to cap or keep capping their revenues for so long. So I think most of those countries, oil is their main source of revenue. So right now it is coming at a cost to have that fight against the U.S. rising production. There's even now, like, nobody's looking at Brazil, but Brazil is also pumping higher than usual. I mean, just taking advantage. So it's a market share play. And for now, the OPEC is fine seeing the market share start to slip a little bit. But once they really get worried, we're probably going to see a reversal. And as more crude gets into the market, that will be sort of the thing that offsets that rise from the trade war agreements, or like having the ceasefires, and all that positive could turn into a negative or downward pressure for crude. if we start to see more of it in the market.
Seeing a question here, real quick. What about the potential billion-dollar purchase of oil by China from the Houston-based energy company? Yeah, and that's you're going to see a lot of some businesses really win on this trade deal. The U.S. is going to see a lot of promises of purchases of U.S. goods. Cheniere Energy is one of the the main natural gas exports for the U.S. and $18 billion is that's a sizable order, and it is going to be very, very positive for Cheniere. But you're going to see that also help U.S. with their exporting of oil, of natural gas, and anything that is supportive of the U.S. is going to really eventually weigh in on that supply side. So, as the U.S. ramps up, as they, as these companies put more capex into, let's get more rigs going, let's get more LNG projects going. Ultimately, that will weigh and possibly, cap any major rallies. But as you know, with oil, we sometimes, we have momentum, accelerate these moves. So it's everything's on a case by case basis. But yeah, that Cheniere was a huge win for them, getting that possibly getting that $18 billion contract, and that will just help U.S. Companies continue to keep these projects going, which will eventually weigh in on that supply side.
Yep, and it speaks more of a sort of that fundamental shift from the U.S. It went from being a net importer to now it's a net exporter. So we've seen this deal with China as a big example. There's sort of whispers about India probably coming on board and starting. So that's another thing. So as much as the U.S. wants to displace, like the market share has to come from somewhere. So I think as we've seen sort of a pressures and sanctions against some nations, the U.S. will try to sort of shift that excess capacity there. So there's a lot of opportunity for sort of U.S. crude, and it's ready to go. The U.S. is ready to go head to head in the international market, something that it hasn't been almost historically out of. So we've seen that that is something that they're pursuing, that their energy agenda is very high on the list of things that they want to get done, very supportive of the energy industry. So we'll see that be the pressure, sort of the countermeasure against OPEC Plus and whatever they do. And as I said before, it's only a matter of time until that deal sort of gets revised. I think they earlier this week, they were talking about maybe April is not the time to discuss. So the next meeting will probably not touch on any comments or specifics on the deal. But as time goes on, it is limiting the revenue of these nations. And as I said before, they are very heavily dependent on that revenue from crude. So as much as they forgo those revenues to keep sort of prices stable, they might be losing sort of market share as the U.S., Brazil, and other producers that are not part of the deal start moving in. Ed, any thoughts on the yellow metal?
It was a nice bullish trend, wasn't it? The strong move that we saw in gold prices, it was trade war uncertainty, Brexit, there was global growth concerns, Europe was weak, Fed's going to be on hold, and then we started to get that optimism on the trade front. China delivered, and we just saw the momentum traders just really just. I know we wrote many articles in the past couple of weeks just highlighting the key shift in sentiment, and there's still a lot of gold bulls out there. There's a lot of people. I've been tracking a lot of people targeting maybe 1,270 as support, 1,250, but the bearish move, the pullback here has been, warranted. It did break below a lot of key levels, and I think I know for myself, one of the key regions, when we take a look at right now, we did break below the 50-day simple moving average, which is right around that psychological 1300 level. Key support for me would be around that 1250 region, which is right where the 200-day simple moving average is. And right now, it's definitely seeing a lot of strong momentum here. Obviously, when you do see a big fall like that, you're going to see profit taking. You're going to see some of those value investors who believe that things are not as good, and they're gonna we'll probably see a little bit more volatility here. But for me, 1250 would be key support, and if that is breached, then I think the next key level that I'd be focusing on is 1220.
I agree with you on the downside. And I mean, the gold train was good while it lasted. Everybody was getting on the gold trains. We saw central banks. We saw sort of the safe haven appetite for the yellow metal rise, and then the 1350 came, and that's a gold ceiling. Like nobody could get through, and started to unravel a little bit. Just we saw the U.S.-China trade talk go in a positive motion, and right now that the appetite for gold has subsided, and rightfully so. I think we've seen that demand for the metal itself is not that high. It's more what it represents and what it could sort of accomplish in times of uncertainty. And I think as right now we've seen uncertainty start to ease, or concerns about the uncertainty from investors started to ease, gold has also gotten the back foot. And I agree with you, 1220 is probably a good level, depending on what goes forward. If we avoid sort of any sort of resparking of the trade war, if everything goes as we think and the details, maybe if not monumental, they're enough to sort of unlock the tariff dispute. And then if the US and Europe don't really engage into anything that could get out of hand, then we'll probably start to see gold sort of start slowly lose all those gains from the end of last year in this, which, I mean, it was a good ride, but I think it was a reaction, or it was a sort of a hedge for something else. And I think as concerns have been easing, but again, we're talking about global macro risk events. So it's never a dull day in the Forex market. So it's never a day in the commodities. It's never a day in the stock market. And we're looking ahead. We still have the Brexit sort of a conversation and the debate ongoing. So don't count out gold. It's like, even though 1220 could be in the cards, we also could get back on track if anything goes sideways. And that those things tend to happen. And we're talking about politics. We're talking about things that are not very rational. And the market just has to find a price and a value for assets during those times. And gold is one of those that benefits from uncertainty, and will definitely have that going forward. Maybe not at the height that we saw at the beginning of the year, but we're not out of the woods yet, and that will definitely help the price of gold going forward.
Great. We do have a question on dollar CAD. I don't know if you could pull up that chart. And the question is, what will the Bank of Canada say tomorrow, and the Canadian employment numbers on Friday? Are we due for a revision?
I think so. Bank of Canada, we touched upon briefly in terms of the hold is probably going to be the decision. The change will probably be in the rhetoric. It's fairly interesting that the Bank of Canada doesn't have really a board of governors. It's like, or members. It's like the Governor Stephen Pawlas. He decides, or he gets to. It sounds like he's like a quarterback that can pull an audible. It is possible. He has done it in the past somewhat, or at least that's what the market sort of the perception is, that he's a bit rogue. But he's also been very clear in telegraphing his intentions for the most part. So I think he's been mixed, sort of gearing towards neutral. It's one of those, like, he's hawkish about the Canadian economy, but he's dovish about global economy and the impact it can have on Canada. So it's a way to sort of hedge his answers or hedge his bets. So expect a bit of dovish rhetoric, the headwinds getting stronger, and more patience being called for. Inflation is still within range, still within the target of the set by the bank, but there are inflationary pressures. So and the weakness of the loonie is one of the reasons for that. And in regards to the job numbers, so jobs in Canada have been sort of perplexing a lot of analysts. It's something that they keep getting stronger. It's for those that don't know, I'm based in Toronto, so I see this every day. So it's interesting just to see the reality of it. So we don't really see those massive jobs, and when those numbers hit, it's a bit perplexing. Where are those jobs? And some of them are part-time, or the majority of them are part-time, but there's also been healthy growth in full-time. So there's this sense that the economy is probably better than people think it is. And there's still a lot of sort of headwinds and a lot of question marks surrounding the Canadian economy. And you could see that in the loonie. So the loonie has been helped and hurt by proximity to the U.S. Sort of NAFTA 2, the USMCA now, was a very hard pill to swallow for sort of the Canadian economy. It took it really gave the loonie a beating for the longest time. And once that cleared up, there was a sort of a lot of optimism. And now we're in this space where oil prices the correlation between the loonie and oil prices has been rising as historically, which is something that it was funny because last year was a bit decoupled from that. So now they're back on as a sort of a pair. So they act in pretty much the same way. And the challenges for the Canadian economy and the loonie itself is just what stance the U.S. takes on trade going forward. As I mentioned, the car tariffs are not only for Europe, it's globally, aluminum, things like that even with the USMCA already signed, it has to be ratified. So there's elections in Canada. There's the sort of the shifting political winds in the U.S. So all that gets taken into consideration when looking at the loonie, just because of how much the Canada depends on U.S. trade. And we'll see that it's still under pressure. It's still sort of underperforming. It was one of the best performers probably during the December, January, February, but now it's losing a bit of steam, and we'll see what happens when sort of elections probably happen. There's political scandals here, so we'll start to see that the economic picture is a bit mixed. So as we get more of positive news, we'll still go with our sort of a bearish view on the loonie versus the dollar, but it also has to do with the dollar. The dollar is, as I mentioned before, it's been going through a lot of or breaking perceptions. It's still strong despite everybody sort of betting against it, but it still remains sort of a major factor, as the U.S. economy seems to be sort of the one that has almost exited recession, or it's in a different gear for sure than comparing to the other global economies, including the Canadian one.
Well said. And just lastly, to go over the expectations. So tomorrow's Bank of Canada meeting, rate hike expectations only 7.6%. When we go to the July meeting, it only goes up to 16%. So, as clearly on hold is expected. And taking a look at the data, the net change in employment is expected to see 1,200 jobs created. The prior reading was 67,000. So expected to come back down to earth. Maybe we will see that downward revision also.
And time flies when you're having fun. I didn't realize we've just hit the 1 hour mark. So we'll probably leave about 5 minutes for any last questions. And thank you guys all for your comments in the questions. That's sort of what we're here for. Glad to see that you find this talks useful. And we're more than happy to do more of them. And just if you have any suggestions, just reach out to the OANDA team and they'll pass it along and we'll introduce them in future webinars. So right now, 5 minutes. Any extra questions that you guys have, comments, please let us know.
And we do have a question on what are your long-term thoughts on the Kiwi dollar?
I think that was someone we've seen, one of the beneficiaries on the trade negotiations. And
while you pull that up, I do want to have a reminder that Craig on next week on March 11th, he'll be tweeting. He'll be covering all the Brexit fireworks. As far as Brexit goes, next week is going to be a critical week, and definitely follow him. First, I'll mention Alfonso's Twitter handle, just in case you don't have it. Alfonso's is at Alfonso Esparza, and mine is at Moya, EDJMOYA. And Craig is at Craig_Forex.
Forex. Yeah, yes. That's correct. Yeah. And also our chief analyst, Dean, he is Dean_Forex as well. And just taking a look at the Kiwi. So we've seen sort of the impact and sort of the reaction, again, back to deep connections on a global scale, and we've seen sort of how the China trade war or even Chinese decisions, be it like fiscal stimulus or just reacting to sort of being on the back foot against the U.S. So that's what we've seen, and sort of that's what we call sort of the commodity currencies, the Aussie, Kiwi, and CAD. Different commodities to understand each of the economies, but overall they're sort of on the. That's how we think about them. And commodities were heavily impacted by the trade war, just because, again, what I mentioned before. So if there's less expectation of growth, then people are going to demand less. So commodities, be it energy, metals for construction, or even like precious and energy. So all that takes a beating, and across the board, like even agricultural products. So again, China, a big importer. So anything on that scale will affect how the currencies do. And so we've seen that how do you sort of balance that against your regional needs or the regional sort of economic indicators. And that's something that we've seen sort of in the Kiwi. Sort of the stability and the sort of recovery has come fast. And another thing that sort of always, when I look at sort of the Kiwi in particular, how it reacts to what's happening, sort of the trends are probably not as long as other currencies that have either more macro levers that are being pulled. So we've seen sort of that stability and that reaction, but it's sort of volatile and it responds to global headwinds, but it probably does so. It's sort of in a sort of the fastest and more sort of a stable way that we've seen in other currencies. Ed, any thoughts on the Kiwi?
I'd just like to add a technical point. Right now, it is tentatively breaking that 50-day SMA, and we are seeing the bullish uptrend for 2019. It's at risk, so things could get exciting if we do break below these levels. 67.50 key support. Things could get ugly on just a technical momentum breakout.
Oh, just reading a bit more of the comments. Yeah. Again, thanks so much for your comments and congratulations. Thank you. It's been a pleasure, and I think Ed will sort of feel the same way. And Ed, any parting words?
No, thank you all for attending. We are very happy to provide this month Outlook webinar where we cover all the key thoughts. Any requests for other types of coverage themes, just let us know. We want to try to help you guys become more informed. So thank you all for attending.
Thank you, and we are signing off. Thank you so much. Have a great day.